Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Chase is off this week on vacation. He'll be back next week to join the show and answer your questions as well. But I've got the show for the next hour here. We'll be taking your phone calls, and we got things to talk about. Very important. I mean, we know that the S&P now is down about, 18%. NASDAQ down 27+%. Things are getting kind of scary. This is when you really have to look at those fundamentals. So what I'm going to do for today is open the phone lines early for you. We do have other things we'll talk about, but the phone number is 833-288-0973. That's 833-288-0973. Get you through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. We do have topics we want to talk about, which is the May Consumer Price Index report. I'll talk about that. Also, the U.S. fertility rate and our economy, how that's affecting it. And then employee 401ks, very important to talk about that now. And then around 8:40 or so, our CFP, our financial planner, Harrison Johnson, will be calling in, talking about potential changes for Social Security. He told me what those were. Like, no, this cannot happen, but he'll share it with you around 8:40. But let's talk about the May Consumer Price Index report. Inflation numbers were released. There was no surprise to the upside or the downside with a year-over-year increase of 8.6%. Now, this was the highest since 1981. I do believe these numbers will be in the high range for another few months because of low numbers 1 year ago. Now, once we get into August and September, I believe we'll start seeing lower increases in inflation numbers. Now, I'm going to say more. It's not going to go away, but I think it'll be more around the 5 or 6% range because the higher numbers that they're compounding on, and also the effects of higher interest rates, along with the increase in the improvement in the in the supply chain. Now, fuel oil, which has been a big cause of inflation, was up 106.7% over the same time frame, and gas climbed 48.7%. Now, if you feel prices are higher at the grocery store, well, yes, you're right, and you may want to avoid the following items if you can. Eggs were up 32% year over year, followed by milk up 15.9%, meat 12.3%, even fish up 12.2%. I guess one can switch to chicken, lamb, and pork, and maybe have pancakes and waffles for breakfast instead of eggs. No surprise here. Also, the University of Michigan Consumer Sentiment came out for June, and that was only 50.2. Consumers are definitely feeling the pinch at the pump and the grocery stores. So, again, we're going to be in this for another few months. I think the same thing with the markets. We're going to have some volatility here. But just think, again, I think looking towards September, October, we'll see numbers improving. Now, not reversing. We're not going to have a 1 or 2% inflation rate, but I think we can see a 5 to 6, which will feel better compared to where we're at right now. So the growth will slow down, I think, after the summer comes on here. Also, too, the U.S. fertility rate and our economy, one major problem for the long-term U.S. economic outlook is the fertility rate. It is now expected that a woman will have 1.66 children over her lifetime. Now, back in 1960, this rate stood at 3.65, and even as recent as 2007, it was 2.1. The current rate poses a problem for growing the population, as the replacement level fertility rate, which is the rate that would keep the population at a consistent size without accounting for immigration, stands at 2.1 children per woman. The problem here is this creates an aging population, which puts stress on GDP growth and benefit systems like Medicare and Social Security. Now, if more people are collecting instead of putting into these programs, that would create a major issue. We know we're starting to see that happen already. Now, one potential catalyst is the increase in weddings. This year is estimated to be 2.6 million couples will get married, and that's a major increase from 2021 of 1.9 million weddings, and also higher than the average year at 2.3 million weddings. Unfortunately, I believe a lot of the increase stems from the delays that were created from COVID, but the trend can hold, perhaps, just perhaps, that could help with a baby shortage we're seeing here in the U.S., but obviously getting married does not guarantee that these people will be having children. And again, obviously, if you have a couple, you need to have more than 2 children. And again, when you talk about the averages, you can have 2.2, 2.3 children, but you need to have more than 2 children in place of 2 people that will pass away. So it is a problem. This is why I have talked about we do need immigration, but it needs to be legal immigration, because we have this deficit. There is a lot of money in our economy, a lot of wealth here in the U.S., a lot of demand for products and services. We need people to fill those voids. And at the current pace we're on, we are not going to be able to do that. We're going to have even more problems 20, 30, 40 years from now. Also, too, let me talk about employee 401ks. At my firm, we have always recommended that employees contribute to the 401ks with a 10% contribution as the goal, and it seems like people are listening. Currently, 70% of U.S. retirement assets are in 401ks, which is double the 35% the assets made up in 1980. Now, remember, if you're over 50, you can add an extra $6,500 on top of the standard $20,500. Also, and I'm hoping this is going to pass, there's a bill in Congress known as the Secure Act of 2.0, and this is one part I hope passes. I'm not sure what the other is in there, but this part I hope does pass, with wording that adds an extra $10,000 for those 60 years and older that they can add to the 401k, so then they can put in $30,500, obviously, into the 401k. And invested properly, a 401k is one of the fastest ways to build good, solid wealth over the long term. And just imagine, you can put in $30,500. Also, too, if your employer has a decent match, this can really get you to retirement quicker. And if you're behind the ball, which unfortunately I've seen people in that situation, they're in their 50s and they don't have enough to retire on, well, you can put the extra $6,500, then you hit age 60, an extra $10,000 on top of that, hopefully. So you can get to where you can build up a nest egg for retirement. So that's something that is going to be helpful. Also, too, I did want to mention signs, because I did say this, but signs in the economy that the supply chain is improving. Where's my notes at there? Let's see. Signs. There are signs that the economy and the supply chain is improving, and consumers could be cutting back a little bit with a rise in the first quarter retail inventories of 26% from a year earlier. So this is a positive sign with the inventory starting to rise on the retail. Before, that was not there at all. We're starting to see that as the supply chain improves. This is not accounting for inflation, however. If there are more items on the shelves, retailers must compete for sales, which benefits consumers with lower prices. They want to get those sales. They want to make them, so they'll cut their prices somewhat. Just this past week, Target provided further proof of this, adding operating margins will be squeezed this quarter as the company liquidates excess inventory. Again, they're going to liquidate more inventory, bring down the prices, helping out the consumer. Wouldn't that be great if we could get someone in the government to understand the same concept when it comes to oil? Let's hope and pray that can happen. And again, higher supply means lower prices, especially if demand stabilizes. And demand will be slowing down on the oil side. So if you find this information useful and interesting, you can sign up for our newsletter. It is free at our website. Go to smartinvesting2000.com. That's smartinvesting2000.com. There's other topics that we talk about. We generally do about, I'm going to say probably about 10 a week on different things that we see that are important that we pull out. We post them on social media. We'll talk about a few here. But if you want to get the full brunt of everything we do, it comes out every Friday, I think Friday afternoon. Again, go to our website, smartinvesting2000.com, smartinvesting2000.com. It's right at the top. You'll see all the signs there. You'll see listen to the podcast. You'll see this at the website. Actually, now we put a little button up on top. It says sign up for the Smart Investing newsletter. So make it very easy for you to do that. Alrighty, phone numbers 833-288-0973. That's 833-288-0973. All lines are open, so give us a call. Get you through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Well, we do get email requests from people, so let me kind of go through those and see what we have here. This came from Jeff. The reason I'm reaching out is because I have a stock I'd be interested in getting your take on. If you hit a lull in the show tomorrow morning, could you read the tea leaves on Crocs, symbol CROX? I've seen them for years, and I'm not a fan of the product. I would be caught dead in those things, and I kind of have to agree. I just don't get the concept myself, but I know they're pretty popular. But when I look at the numbers, I like what I see. I don't think it pays a dividend, which is disappointing. But beyond that, it seems like it has promise. I don't have easy access to all the numbers. You guys do, and even if I did, I can't interpret them the way you do. Love the show, and thanks for the way you handle our money. All right, so let's put in the numbers here for Crocs again. Let's see. Wake up here, computer. There we go. Look, I put in the symbol CROX. And I have thought about this one myself because I know this was popular, and I was thinking too, perhaps with people cutting back, I don't believe these shoes are very expensive. They may say, you know what, let's get these Crocs. And some people love them. They love the way they look. Myself, I don't. All right, looking at the share percentage float here, on short side, not very high, 5.1. I'm okay with that. Is institutional ownership 83.6. Wow, very nice PE ratio, 4.8 versus 24.9. I like seeing that. We do see price of sales looks good, 1.3 versus 2.3. Price to book value, not material for the tangible book value versus 36.1. So it means they have a lot of intangible assets, which I'd want to know what those are before I invest in the company. They could have to be written down, which would be a problem. But price to cash flow comes back to looking good as well, 7.2 versus 21.3. And a very nice PEG ratio, 0.5 versus 4.2. So showing you're not paying much for the growth of this company. Now, the earnings growth over the past year is 89% versus 24% for the industry. That's a big positive. And even their sales are up 61% versus 12.1%. So the company's doing very well. The 5-year growth rate on the earnings is 10%. That's not bad. The industry does show 24.6%. They do not pay a dividend. Let's take a peek at the balance sheet here. We see a current ratio 2 versus 2.7. That's okay. Debt equity, doggone it, here comes a problem. 8.9 versus 0.9. That means they have an 890% debt over equity. That just wipes out the whole thing here because you don't want to get a company with that much debt, especially with those intangibles. What if they have problems paying that debt? So very disappointed seeing that. I'll continue on, see what else we see here because maybe there's something on that. And sometimes, too, it could be, and I don't have time to look at the balance sheet today, but it could be that the equity is very low and maybe the debt's not that high. So while I'm saying it doesn't look good here, sometimes the numbers will mean something different, and this is where you've got to do a lot more research. But the net profit margin is very good, 27.9 versus 9.8. Return on equity, 200.5 versus 39.4. Now, again, this is where I talk about the numbers because return on equity, 200%, it's telling me that equity is probably very low. So maybe the debt is not as bad as we think it is, and they do have a good current ratio. We also do see return on invested capital is 21.4 versus 20.9. I see the stock closed at $53.82 on Friday. Wow, the high, $183.88. The low, $47.33. So they are getting close to the low there. Year to date, the stock is down 58%. That is quite the big decline. And their market cap is not that large, $3.3 billion. Let's take a look at the analysts going forward, see what they say for the earnings. Now, I do see going out to December 2023, they have earnings projected of $12.17. Let me do the multiple of that times 16.6, which is what we use for the forward PE. That would give us a target sell price of $202. And also, too, I got to say there's 10 analysts. The estimates are pretty close. The low estimate's 1123. The high is 1355. So that tells me those numbers are pretty good. We do see over the last 90 days The estimate hasn't moved that much. 90 days ago, it was at $12.33. Today, again, $12.17, so not much of a decline there. Analysts over the last 30 days have increased by 3 of the revisions there. So the only thing I would do, I like what I'm seeing. I like the valuation ratios. I also like the earnings going forward. I like the tightness of those earnings. I just would want to verify what I said. You need to go to the balance sheet to do that, to see what the balance sheet looks like, to see, you know what, no one's called in yet, so I'm going to go ahead and I'm going to take a look at the balance sheet just because I'm very curious on this myself, and see if we can see any information here that'll help us out. Now, this is as of March 2022. Looking at, let's go down to the equity first. Now, the equity is $349 million, which is not that large. But when I go to the debt, where's the debt at? Okay, long-term debt, it is $3 billion. So, yeah, I'm kind of disappointed with that. I thought that with return to equity of 200%, at 349, it'd be a very small one. Now, in December 2020, the equity was $14 million, jumped to $349 million in the next quarter. So, what I would do, see, and here is also something strange. December 2021, the debt was $921 million. Then it jumped to $3 billion. So you want to find out why they take on about $2 billion of debt. That really kind of put them out of the, a very leveraged position is what it did. So I would check that, because I almost think it's worth it, because I like the company. I don't like the shoes, but I like that people like the shoes, and I like to see that people are actually buying the shoes and low valuation ratios. So, Jeff, that's why I stand for Crocs. No definite answer there, but definitely some good possibility for the research, especially with being down, what I say, 50% for the year. So, all right, phone numbers 833-288-0973. That's 833-288-0973, and that will get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. Let's just talk about something really quick here that I want to kind of mention to you, and that is about in regards to, let me turn the page here, major spike price in diamonds. Along with many other things in life, diamonds have also seen a major price spike. With a huge wedding boom after COVID, demand for diamonds grew 60% in 2021, but production grew by only 5%. This led to global price increasing about 21% in 2021, and I believe pricing in 2022 is unlikely to improve. And by improving, I mean go down if you're buying a diamond. A major reason for this is about a third of the diamonds come from Russia mining company Alrosa, and we know how the world feels about Russia at this time. If you're looking at buying a diamond this time, you may want to consider alternatives such as lab-grown diamonds. Now, these are real diamonds. They're just grown in the lab, as opposed to waiting, I think it takes hundreds of years, I believe, for a diamond to actually really become a diamond. So they can now, duplicate that process in the lab, so they're real diamonds. And they're not the cubic zirconians. Those are not diamonds. They're like a glass. They're not a diamond, but a lab-grown diamond is real. It just was produced much quicker than the normal that it would take. So that is the major spike in price in diamonds, and I wonder how that will perhaps keep the price down. If you can produce these diamonds, what will happen with that? All right, phone numbers, again, 833-288-0973. Let's go out to San Diego and speak with, I don't have his name here, Al. Let's speak with Al. Al, you're on the Smart Investor with Brent Chase. How can we help you out?
Yeah, I wanted to ask you about EFC. I don't own it.
You don't own it. EFC. All right, let's take a look at EFC. And I come up with Ellington Financial. Is that the company?
That's it.
All right. Well, let's take a look at Ellington Financial, symbol EFC. They're in the REIT mortgage industry. About 4.6% float is on the stock. About 60% owned by institutions. Not a bad start here, Al. The PE ratio is 10.1 versus 12.6. Price to sales 9.8 versus 5.4. Don't like seeing that one. That's too high. Price to book value 0.9 versus 9.4. That's a big positive. And price to cash flow 10.9 versus 6.9. That's not good, but it does have a good PEG ratio, 2.1 versus 48.3. Now, looking at the past year, there seems to be a problem here. The earnings were down 63.9%, but that was the same for the industry, so I'm not sure why the earnings are down that much over the past year. Sales were also down 57.2%. The industry is down 48.6%. And again, this is the REIT mortgage. So I guess what's going on here is with the rising interest rates, this is really hurting the REIT mortgage industry. We do see that the EPS growth rate over the next 5 years does look good, however, 4.3% versus 1.5%. Now, here's probably why you like this one. The dividend yield is 11.5%. It does show they use 115.5% of their earnings to pay out that big yield there. So that would worry me. That means they either have to increase their earnings or they have to decrease that yield, obviously. On the balance sheet, it's a mortgage REIT, so I'm not going to see some normal things here. I do, unfortunately, see a debt to equity of 3.3 that is higher than the industry at 1.8. Net profit margin 104.8% versus 50.3%. And I think a lot of these numbers are very strange here, Al, because of it's a mortgage REIT. And mortgages, they pay principal and interest. Could be still some effects of refinancing going on. We do have rates rising, which should slow that down going forward. But I still think we're getting some strange numbers, which are over the past year. Return on equity is only 6% versus 10.3%. I like to see that around 15%. On the stock price, we see it's currently $15.67. The high is $19.60. The low is $14.28. The market cap is only $940 million. Let me see if I can get some numbers here on the estimates going forward. We do see we have an estimate here for December 2023 of $1.86. If I put a multiple of 16.6 on that, let's see, I would get, looks like 31, so that's to be the target sell price, 31. And there's 5 analysts, pretty tight number there as well. One says 180, somebody at the top says 190, and the trend is held pretty good, $1.88. The downside is $1.86, only down 2 cents over the last 90 days. And I'm trying to think through this as I'm speaking here, Al. I believe these mortgage REITs will do well going forward because there's going to be less refinancing going on. So they may keep those in. But I'm not sure how this will affect a mortgage REIT with new mortgages coming in at higher rates. It should be a positive, but I'd want to study that a little bit more. I think it could be worth it because even if they cut that dividend down to 9 or 10%, that's pretty good. But you really do want to understand what kind of mortgage do they have in there. Hopefully they don't have subprime mortgages, because if we do hit a recession, which I don't think we will, but if we do, that could cause problem and people could start defaulting on their mortgages, hurting them. So worth the research, but I would not buy it this time until I understood more about it. All righty?
Thanks a lot.
Thanks, Al. Have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. Let's go to San Diego and speak with Anthony. Anthony, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hi, good morning. Thanks for taking my call. I was wanting to ask about Intel, INTC. I don't own it yet, but I was wondering if you think it might be a good value at the current price.
Okay, yeah, let's take a look at that. And are you looking at buying it, you said? Or
Yes, I'm looking to buy it.
Okay, well, let's take a look at that. I know Intel, I believe they have spent or talked about spending, I believe, $60 to $80 billion to actually build new plants and stuff. And they're trying to be, the U.S. chip company because we got Taiwan Semiconductors and other ones that are not here in the U.S., so they're trying to do that, which could take some time. But let's take a look at the numbers on Intel, symbol is INTC, only 1.3% short on the float side, so that's very low. So they are not expecting this stock to go lower here. 65% institutional ownership, a very nice PE ratio, 6.5 versus 18.7. Price to sales 2.1 versus 4.6. Price to book value 2.3. The industry is well over 100, so that's a big positive for Intel. Price to cash flow 5.3 versus 12.5, and the PEG ratio 3.6 versus 4.3. So all the valuation ratios and the PEG ratio all positive for Intel. Now, over the past year, Intel did increase their earnings by 35.3%. The industry is up 50%. Over the last year, the sales were actually flat, which is not good for Intel. It's part of the problem. They're having a hard time growing on the short term. The industry was up 11.1, and the 5-year earnings per share growth rate for Intel is only 3.2 versus 16.9. So that's not very good. We'd hate to see that low, but I think they can turn it around once they get those factories online, which will take some time. Now, you get a nice dividend from Intel. It's 3.7%. They only use 23.3% of their earnings to pay out that dividend. We do see on the balance sheet, you got a current ratio of 2.1 versus 3.1. Debt to equity is only 0.4 for Intel versus 0.6 for the industry. Net profit margin, well, that checks in at 31.7% versus 25.3. So Intel, you got to realize this. They make, even though they don't make as much product-wise, they do make 32% on every product that they do put out versus 25% for the average of the industry. And then return to equity for Intel is 23.9, very good. Industry is at 26.5. Now, looking at the share prices here, we do see yesterday closed at $39.18. The 52-week high is $58.42. The low is that $39.18. Their market cap is $160 billion. Let's take a look at the earnings going forward for Intel. We do see that going out to December of 2023. We have earnings of $3.59. There's 34 analysts that give that number. And if we take that multiple times 16.6, we do get a target sell price of 60, which is probably about 30% plus over where the stock price is now. One thing I am a little bit concerned about, I want to point this out, is that the low estimate is $2.64. The high estimate is $4.06, so it's a pretty big range, but you do have 34 analysts, so you want to keep that in mind. And those numbers are coming down. They were $3.72 back 90 days ago. They're now $3.59, so they are declining. But in Intel, when you read what they do, and they got the new CEO, they got a new management team, it does take time to turn that big ship around. But I believe they will do it, and I do believe you'll see other chip makers actually come down a lot. If you do invest in Intel, you probably don't have much downside, but it could take a little bit of time. And for us, 12, 18, 24 months, we're patient. We're willing to wait that long. Plus, you do get a nice dividend in this market. We're willing to wait that long for it. So I like Intel at these numbers here. It's just it's not going to be a big growth for you, but I think it will be a nice, stable investment to have long-term in your portfolio. All righty?
Thank you.
You're welcome. Have a good one. All righty. That does open the phone line, 833-288-0973. That's 833-288-0973. Let's go to San Marcos and speak with Phil. Phil, you're on the Smart Investment Show, Brent Chase. How can we help you?
Hey, Brent. How's it going?
Good. How you doing?
Hey, good. Hey, wanted to chat a little bit about Visa, symbol V. I've been in and out of Visa for the last few years. Currently out, but I've been seeing it drop, and curious to see your analytics on the valuation.
Are you in it right now, or are you looking at getting back into it?
No, looking to get back into it.
And I think it was on social media, I got a question, what effect I would think higher interest rates would have on credit cards. And I didn't really look into it, just my quick analysis is I don't believe it would have any effect on credit cards because they get paid a fee, not a percent of what they're earning. So no research, that's just a thing there. So, but let's take a look at Visa, because I know they have been very high, very expensive, and I wouldn't ever buy them at those levels. Are too expensive, but let's see if they're becoming more reasonable now. The symbol for Visa is V, not much short on it, 1.7%. High institutional ownership, 97%. We do see a PE ratio very high, 31.4 versus 17. Price to sales, 16 versus 4.5. That is high, along with price to tangible book value, nothing there. It's not material versus 49 for the industry. And then price of cash flow expensive as well, 26.8 versus 14.3. PEG ratio does look pretty good, though, 1.5 versus 2.9. Now, over the last year, Visa has grown their earnings by 31.6%. That is below the industry earnings growth of 47.9. The sales for Visa up 26.1% versus 23.9% for the industry, so slightly better there. The 5-year growth rate on the earnings for Visa, 18.1% versus 18.4%, so good growth rate, about the same as the industry. Now, they do pay a dividend, but it's only 0.8%, and they use 22% of their earnings to pay that out, so that's a little bit disappointing there. I'd like to see a better dividend from them. Perhaps that will change in the future. The balance sheet, we got a current ratio 1.3, same as the industry. Debt to equity is very good for Visa, 0.6. I say that because the industry is at 1.4. I do see that the net profit margin is 51.1% versus 26.9. And I know over the years Congress has tried to, get them to lower that and so forth, saying they're too profitable. They just kind of do it in a different direction. Return on equity for Visa, 38.3 versus 41.9. The price on Friday was $199.51. The high, they have pulled back, $252.67. The low is $186.67. Year to date, not doing too bad. Again, they're down 7.6%. The S&P 500 is down about 18.8. They do have a big market cap of $422 billion. Let's go forward here, see what the analysts say for the company going forward in the earnings. We do see an earnings increase from September 2022 from $7.15 to September 2023 of $8.37. Let me get a target sell price on that here for you to see what the target.
That doesn't look good.
Well, it's growing, but not as much as we probably like. And I do say we got a target sell price of only $139, so that is below the current price. And looking at the analysts, there are 35 analysts. They do believe that 837 is pretty strong. 767 is a low, 866. Actually, that number is down. The earnings over the last 9 days, it was 850 90 days ago, and now 837. And why I think with rising interest rates, I don't think it's going to affect Visa and MasterCard. But if consumers do slow down on their spending and using their credit card, then that would hurt them. Now, on the other hand, many times if people start, because a lot of people had a lot of cash, so they're using cash. Well, now if they start building debt, they could use a credit card more. So, what I say the target price was $139. I just would not want to go back into this. I mean, you could see the stock fall perhaps down to $100 if we do hit a recession. They may not be able to weather the storm that well. So I would say stay away from it at this point in time.
All right, Brent. Hey, appreciate it as always.
All right,
Have a good
Phil.
weekend.
Well, thanks for calling. You have a good one. All right.
Yeah.
Bye-bye. All righty. That does over the phone line, 833-288-0973. That's 833-288-0973. Before I go to Mike in Oceanside, I do want to talk to Harrison, our financial planner. Harrison, good morning. How are you doing this morning?
Good morning, Brent. I'm doing well.
Well, good. I teased with it this morning because the potential change of Social Security, and I told people they're not good. Hopefully these don't come on through, but why don't you explain what you're talking about here?
So I get questions about this quite a bit, and right now, by 2035, there's only supposed to be enough money in Social Security to pay out 80% of benefits. So some people say, well, it's not going to be there. And I say it's probably going to be there. It might look a little bit different. So this week there was a proposal that came out from Bernie Sanders and Elizabeth Warren and some of these other people. And in this proposal, they have a plan to extend the solvency for another 75 years. In that plan, there are some provisions that increase benefits on Social Security. Some of them are just a flat $200 a month increase for everybody, an increase to the cost of living adjustment that Social Security uses, an increased minimum payment that people would get. So like a low threshold that everybody would receive, they would increase that minimum of what that would be. There would be some more increasing of student and child benefits, and then they would combine disability and Social Security together into one fund. So those are some of the increases that this would happen. Now the question is, how is that going to be done, or how is this proposed to be done? So right now, Social Security is funded by taxes that we pay on wages and self-employment income. If you are an employee, a W-2 employee, you pay 6.2% of your gross earnings into Social Security, and your employer does 6.2% for you as well. If you're self-employed, you are both the employee and the employer. You pay both of those taxes, so 12.4%. So that tax, the 6.2% tax, goes up to wages of $147,000. If you make more than that, you're only taxed on up to $147,000. That's the current way it works. So the plan now that's proposed came out on Thursday of this week, was to lift that cap and subject all income above $250,000 to that Social Security tax. So you'd be taxed up to that 147, and you'd have a little bit of a gap, and then everything above $250,000 would be taxed. Now, in the verbiage, it says all income above $250,000, and I'm not sure if that really means all income, because again, right now it's just wages that are taxed. But there's another provision in here where it changes the way net investment income is taxed. So currently, if your AGI, adjusted gross income, is above $250,000, there is an additional 3.8% tax on all investment income. So that's capital gains, dividends, interest, rental income, sources like that. So this proposal would increase that 3.8% tax by 12.4% up to 16.2% tax on all investment income if your AGI is above 250 grand. And also, it would expand that to include some pass-through income from S corps and partnership income. So virtually pretty much every income source out there, or most income sources out there, would be subject to now this new 12.4% tax for incomes above $250,000. That is a massive, massive tax increase. And it's kind of funny, in here it always talks about, we want to require the wealthiest to pay their fair share, but there's a provision here that says, this extra tax that these people would be paying does not credit any additional earnings for them. So for the people that would be paying these extra taxes, they would not receive any increased Social Security benefits when they're actually collecting in retirement. So, the way Social Security works is it's based on your career earnings, up to 35 years of career earnings, and the more you pay into it through higher income, the more you get back. But it's on a decreasing scale, so it really kind of favors lower income workers because they get back a higher percentage of what they put in. But again, this tax increase for incomes above $250,000 would have no impact on the benefits that those people would be paying. So if I look at how likely this piece of legislation is going to get passed, I'd say it's probably not that likely, but something is probably going to happen. As I said, by 2035, that the Social Security Trust Fund is going to be insolvent, and they'll only have enough in there to pay 80% out, because that's what people are currently paying into the system. So it is likely that either we're going to see some type of decreased benefits or increased taxes. So, in the future, I think it's very possible that we could see increased taxes. So you want to be very careful when you're accumulating and managing your wealth that you have some flexibility in there and some tax diversification where this isn't going to hurt you too bad if we do see some tax increases.
Yeah, and Harrison, I get their numbers and I know what they're trying to do, but you just can't do that because of the fact that it's just so excessive. And you're right. You're going to put all this money in. It de-incentivizes people. What I've always said they should do is that I think they're just too liberal with the benefits. I mean, gosh, I've heard that you work 12 quarters, you get these numbers I'm guessing at, maybe you know the numbers. You work 12 quarters, you get full benefits for the rest of your life. I mean, how can that be? It's just the benefits are too easy, which drains the system. So what I think they need to do is kind of look at the benefits and try to pull back some of those survivor benefits they have. I mean, it just seems, too easy. And yeah, they're going to have that shortage in 2035. I always felt what they would do is cut back on the benefits and I tell people, you will get Social Security, but maybe instead of getting 100%, maybe you get like 80% of what you thought you're going to get. That to me kind of makes sense. But you're right, though. They'll probably raise it somehow, some way, But I think they should cut back on the benefits as well because they're just too liberal and too many people get benefits that, it just too easy.
Yeah, so the way you have to work for 10 years, and that's when you'll receive benefits. One of the ways that I thought would help is just to increase the retirement age. It used to be 65, and then it got increased to 66 and 67. But that would be a way of technically decreasing benefits, but you're still getting the same monthly amount. You just have to wait a little bit longer in order to get it. So either way, though, there's going to be some changes to it. And something like this, I mean, a 12.4% flat tax on income above $250,000, I mean, that's huge. I mean, small business owners would get crushed by that, which, I mean, that would have ripple effects across everything. So
yeah, and also too, I think the disability, because that's part of that as well. The disability benefits, they seem to be. And I know a judge that actually is a federal disability judge, and the cases that he gets come through there. I mean, they're just ludicrous, and he doesn't pass them. But I guess they can wait like a year or so, go in front of another judge. You play the judge game, eventually get a judge that will pass it. But some people on disability that they shouldn't be. They're able to work, but because they got, I don't know, I'm being facetious here, but a broken finger, I can't work any longer. They've got too many people. I remember seeing this number a while ago, but the people on disability is also increasing dramatically, which that too, I believe, drains the fund as well, correct?
it is. So
Yep.
there's Social Security, old age retirement income, and then there's Social Security disability income, which is a separate piece of it. It's all in the same Social Security administration.
So the same big fund that comes out of, but so it is a problem, and that's why we vote here in the country and kind of listen to what people are looking at and vote for you think who's going to do the best thing with your money going forward. So
Yeah.
and this is also too why it's so important to the financial planning, because you may not be able to count it. And Social Security was never meant to be a full retirement benefit. It was supposed to be a supplement. So that's really important too, why you got to do your financial planning to build your retirement, to supplement your retirement. So,
And to set up your income sources so that you can hopefully avoid some of these taxes.
there you go. Yeah. Well, Harrison, thank you very much. You have a good one. We'll see you on Monday morning.
Thanks, Brent. We'll see you Monday.
Okay. Bye-bye. All right, again, that's Harrison Johnson, our financial planner. If you are looking at retiring, you need a financial plan. Again, Harrison is on a salary. He does not get commissions. We do not sell product. It is a fee-based plan. If you want an unbiased opinion on your plan, you get a free consultation with him first. Give him a call to the office, 858-546-4306. That's 858-546-4306. Or go to the website smartinvesting2000.com. That's smartinvesting2000.com. Click on where it says meet the team, and you'll see Harrison there. You can send him an email, and he can contact you that way. Alrighty, phone number's here, 833-288-0973. That's 833-288-0973. Let's up to Oceanside and talk with Mike. Mike, you're on the Smart Invest Show, Brent Chase. How can we help you out?
How you doing, Brent?
Good. How you doing?
I know this is probably not one of the stocks that's in your wheelhouse. It's kind of discretionary income for me. It was kind of speculative, but about 15 years ago, I looked at where oil was going, and it was going down and down and down. I cost averaged into rig, which I had seen years ago during the last oil crisis we had. I'm 61, so I remember a couple of them. And I got it down to, I started at about $6, and then it got down around $2 for rig, RIG, and they're an offshore platform drilling company, and that was one of the first things to kind of get phased out. A lot of their rigs were out of service, but they were one of the largest, and they were very, very high at one time when the big oil crisis happened. And I just knew that with the switch over to electric being too soon, too quick to service the world, that eventually, these companies would have to start maybe drilling offshore again, although it's not real favorable in the United States. And I think I'm I'm at about 3 something, accumulated over 1,000 shares, and it got a little pop here with the recent activity, and I'm just wondering, it doesn't look like oil prices are going down anytime soon, and will that force them, back to drilling offshore? They do it in the North Sea and a lot of those places, not so much in the United States.
Yeah, and it's funny. I looked at this company myself about 15 years ago because it was a big thing, Transocean, this and that. And I looked at it. I can't remember the reason why I didn't buy it, but I remember I liked it. I thought the fundamentals, and again, I'm going back 15, 20 years ago, looked pretty good, but there was something about it I didn't like. I'm obviously glad I did not purchase it. But as you're talking to, you're right. Perhaps this is one thing we could do, because I was driving in today and I saw gas, $6.50. It continues to increase. Something has to be done. Maybe this could be to loosen up a little bit on the offshore drilling. So let's take a look at the numbers on Transocean. Again, their symbol is RIG. They are in the oil and gas drilling industry. They do have about 10% float on it on the short side, which is not high, but it's a little bit higher than normal. Institutional ownership is only 54%. They do not have a PE ratio, which means no earnings over the last 12 months. Price of sales still looks high, 1.2 versus 0.5. Price to book value, though, is only 0.3 versus 1.8. So that tells you you're only paying 30 cents for the price for the tangible book value of these assets here, which is incredible. Doesn't mean that the company can't go under, but it is a positive sign. The industry is at 1.8. Price to cash flow is 6 versus 4.9. Now, last year there's no earnings. Sales, unfortunately, last year did decline by 18%. The industry was down 6.2. Now, here's a big positive, and I don't know how they came up with this, but the 5-year earnings per share growth estimate for RIG is 156% versus 11.3. If they can accomplish that, this stock would actually probably skyrocket going forward, and perhaps the analysts are thinking that they will go back to offshore drilling because they have to. Maybe that could be the thing. They do not pay a dividend. Very important, the balance sheet. Current ratio 1.7 versus 1.5. That's a positive. Debt to equity is pretty good. It's only 0.6 versus 1.3. So that's nice to see that. Net profit margin is a negative 26.8 versus a negative 11.8. Return on equity is a negative 6 versus a negative 10.4. Looking at the share price on Friday, it was $4.40. The high is only $5.56, but the low is $2.63. So they have come up somewhat. Even though it's the small share price, they still have a market cap of $3 billion here. Let's check to see if there's any earnings going forward. Unfortunately, going out to December 2023, they're still looking for a loss of 33 cents, better than the loss of 2022 of 61 cents. 7 analysts follow this. No one thinks they're going to earn any money at all. Even the high estimate is a loss of 15 cents and a low is a loss of 62 cents. It's just something that I can't invest in a company. Even that great tangible book value, they've got to have some earnings because while it looks cheap around $4 a share, if it falls $2, you lost another 50%. So I would have to stay away from it until we see some positive here on the earnings going forward. All ready?
Thank you very much.
Okay, Mike, thanks for calling. You have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. We did get actually, Chase got this one. It was on his Instagram. It says MT on Instagram. Hey, Chase, love your show. I'm pretty busy during Saturdays, but I listen to your podcast during the week. If you're slow on calls, would you be able to check out Brilliant Earth? I got my fiance's engagement ring from them and like what they are about. They also have seem to have a low PE ratio and a decent past 3 weeks with all this craziness. Have a great weekend. Well, shoot, I just realized he does not have the symbol here. Let me see if I can find this or not. Here, MT, I'll see what I can do here for you because I'll put in Brilliant Earth, see if anything comes up. And I don't think, Brilliant Earth Group. I think that's probably it. Their symbol appears to be BRLT. So I'm going to go with that one there. Let's see here. Yeah. Okay. So they're in the industry of luxury goods, so I believe I got it there. So Brilliant Earth Group, symbol BRLT, and this is for MT on Instagram, who listens by the podcast. Shares float 7.3%, institutional ownership 71%. Unfortunately here, no PE ratio versus 23.6 for the industry. Price to sales looks very attractive, 0.1 versus 3. Price to book value 5.9. That's attractive because the industry is not material. And price to cash flow is 1.4 versus 12. They do not have a PEG ratio. I do not see any earnings growth or sales growth over the last year or even 5 years. They do not pay a dividend. Let's take a look at the balance sheet here. Current ratio 1.9. That is better than the industry at 1.8, but debt to equity not looking good. 9.4 versus 0.9. So you want to look at the balance sheet to see, do they have a lot of debt? Low equity. Is that debt increasing, decreasing? What's going on with the debt there? We do see a net profit margin of a negative 0.1% versus positive 13%. Return on equity is a negative 5.7 versus a positive 25.1. Oh my gosh, and the stock price on Friday was $5 and a penny. The high was $20.39. The low is $3.60. They're down 72% year to date. I think that could be because of the earnings that they're, or the way the balance sheet does look. Also, too, the market cap only $54 million. Very small company, could be here today, gone tomorrow. Let's see if there's any earnings estimates for the company going forward. And actually they are, and they actually don't look too bad. December 2023, 43 cents. That's based on 7 analysts. That is up from 2022 when it's 23 cents. If I put a multiple of 16.6 on that, I will get a stock price of $7. So it does give you a little bit of room, but you really got to look at this company deeper. Again, very small company, only $50 million market cap. You've got a lot of debt there. Could be here today, gone tomorrow. They're probably expanding. This is where you want to really listen to the last conference call, see what their plans are, really read into the company, understand it, because you got the potential growth on the analysts. The range of those estimates is unfortunately pretty high. It's 31 cents the low, 60 cents is the high. So you might want to look into it. We could never buy it because we'd have to buy the whole company with $50 million. And also, too, the trading on it may be rather small because the stock is small. Alrighty. Hope that helps out, MT, and I'm glad you listen to the podcast. And again, if you like the show and you can't always catch the show, you can go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can click on the podcast button, and you can see how you can listen to the show by podcast. All right, let's go back to the phones. Let's go to Pacific Beach and speak with Mike. Mike, you're on the Smart Investor with Brent Chase. How can we help you?
Hi, thanks for all the information you give out every week. It's really great and helps me out. I was calling about IEP. It's a very diverse company, and my friend and I talked about it, and we don't own it, but we'd like to get your opinion.
And I know this is a Carl Icahn, and I've always liked Carl Icahn's investment philosophy. I mean, he really is he's not quite a value investor, but he does like to look at the businesses and understand the businesses. And this is kind of his company, which actually has all those businesses in it. So sometimes it doesn't look very well, but I'm very curious myself to see what it looks like. So it's Icahn Enterprises. Symbol is IEP. They are in the industry conglomerates, so there's only 0.7% float on the stock, 88% institutional ownership. And I do believe Carl Icahn does have, I want to say 30 or 40% of this company. I could be wrong on that number, but I think he has a big holding of this. We do see no PE ratio versus 15.6 for the industry. Price to sales comes in at 1.2 versus 0.6, and that's okay. Price to book value 6.1. That is better than the industry at 9.3. And price to cash flow is 5 versus 10.8, so that's a positive as well. Now, we do not see any earnings growth over the past year, but sales were up 50.5% versus 34.4. It does pay a 15.6% dividend, but the payout ratio is not material because it had no earnings. So I'm not sure how he's paying out such a large dividend of $8. That could have been a special dividend or one-time things, or it could be the dividend goes, from $8 to $2 to $5. It could be all over the board each year. So I'd want to understand how that dividend has been in the past. We do see that on the balance sheet, current ratio 4.3 versus 1.5. Debt to equity 2.3. That's above the industry at 1.2. I don't know how that works, if he's using leverage there or what. But again, you really want to understand more about the Icon Enterprises before we get into it, because he is buying just a lot of companies in there, and I believe he does leverage some of those as well. Net profit margin is a negative 3% versus a positive 6.3. Return on equity a negative 14.5 versus a positive 15.2. The price now is $51.27. The high, $59.11. The low, very tight range here, only $48.93. Year to date, it is up 11.5%. Let's take a look at the analysts going forward, see if there's any earnings for Icon Enterprises going forward. And there are. It's 68 cents, only one analyst though. And I know that if I put a target sell price on that, it's going to be very low. It's not even hardly worth doing here, but I'll do it just for the, see what it is. Yeah, it's $11, nowhere near what the target price is. This is a whole different investment. I think if you read more about this, I think you're really investing in Carl Icahn. What's he going to do? I know he's also getting older. I want to say he's in his 80s, maybe approaching 90. So you also have the Warren Buffett thing here. Is he going to continue going on, or is he going to be done in a while? So I think you could read more about this. Based on the fundamentals, it's not a buy, but you'd be buying, again, not the Warren Buffett, the Carl Icahn philosophy, which I think is a pretty good one. All righty?
All right. Well, that helps me out a lot. Thank you very much, and appreciate your show.
Okay, Mike. Well, thanks for calling, and you have a good one.
You too. Bye-bye.
Bye-bye. All right. I'd say that opens on the phone line, but we only got about 2 minutes left here, so I do want to just talk quickly about mortgage demand continues to decline as rates rise and affordability remains challenging. Last week, applications to purchase a home fell by 7% for the week and were 21% lower compared to last year. With many homeowners locking in lower rates over the last few years, refinance demand has dropped significantly. Last week, refinance demand dropped 6% compared to the prior week, and compared to last year, it was down 75%. So there's no point in refinancing. Obviously, rates are going up. Overall, mortgage demand came in at its lowest level in 22 years. With this reduced demand, I'm still looking for a 5 to 10% pullback in housing prices over the next year or so. It's just going to be very hard to keep that demand going, because what really kept houses high was the big demand and the crazy offers and so forth. Well, if rates are going up, you're not going to have as many people doing that. I have heard from people I know in the industry saying, yeah, you're not seeing that as much before. You no longer see the multiple offers. Now starting to see maybe offers a little bit lower than what the asking price is. So the market seems to be loosening up a little bit. It's hard to say, will the market drop 5%, 10%? I don't believe it would drop 20%. That would be terrible if it did that. I think it would take a terrible recession for that to happen, partly because the inventory. We still don't have a high inventory on homes, but I still think there are people saying, you know what, my home's at the top price. We're what do they call it? Without kids, there's a name for it. Well, you're retired, you have no kids at the home, you got this 5-bedroom home, no one's there. I think we'll sell for a smaller house. Well, there's the closing bell. So thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. Right there, you can sign up for the newsletter. Part what you heard here. A lot more to it. It is free. Again, right there on the smartinvesting2000.com. Have a great day. We'll talk more next week right here on the Smart Investing Show.
I did all that, and may I say,